Good afternoon, and welcome to Scotia iTRADE's webinar. My name is Conley, the Client Education Specialist with Scotia iTRADE. I'm pleased to present to you today options trading mistakes to avoid with the Montreal Exchange. So, of course, just before we get started, we'll just take care of some quick housekeeping items, and then we'll jump right in. So, your sound quality should be good, but you can check this your quality by clicking on the sound check link in the audio panel of your GoToWebinar toolbar. Now, the setup window may be on your secondary screen if indeed you're using two monitors. Just please be reminded that everyone will be muted for sound quality purposes today. And if you're calling in, if you're using your computer and are experiencing any sound quality issues, you can always switch over to the telephone. Simply give us a call using the telephone number you see on screen with the access code and your audio PIN. As a quick reminder, unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively called the content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. So the information that we're presenting to you today will be for informational and educational purposes only, not intended for advice, recommendations, or any opinions. And also, just keep in mind that options do involve risk. They're not suitable for all investors. They are intended for sophisticated investors. So before trading options, just carefully review the options account agreement, which is contained in the Scotia iTRADE relationship disclosure document and terms and conditions. Now, I've got the link here on page, but if you'd like to get that, I can always email it out to you. Just let me know. Send me a quick email to education@scotiaitrade.com, and I can send that to you, or just go on to our scotiaitrade.com webpage under the documents, and you'll find that there under our files and documents. So let's quickly review the toolbar's feature. The orange arrow that you see at the top there can be used to hide or to minimize that control panel. So if it does disappear from you and you'd like to reappear it, just click on the orange arrow and it'll come back. Also, you can view in full screen mode just by clicking the computer icon on your GoToWebinar toolbar. Now, if you've got a question, you can use the hand signal, the hand icon, to just let me know if you've got a question. But you can also just go right ahead and type the questions into the question panel box, as I'll be monitoring those and interacting with you live as you do that. Now, our presenter may elect to answer questions in the presentation, or we have a Q&A session set up at the end of the presentation. So if in fact you don't get an answer immediately, don't forget we will be actually addressing those questions in the Q&A sessions at the end. So today's session is going to be recorded, and you'll receive an email link within 1 business day. If you do not receive one, just let me know, and I can send that out to you, no problem. Alternatively, just visit our YouTube channel. We've got a Webinars on Demand playlist there on our YouTube channel. Simply go to the iTrade.com website, scroll to the very bottom of the page, and you'll see the YouTube link. Click on that, and then, of course, you'll see the page displayed here. Go to the playlist, click on Webinars on Demand to find us there. I'm also going to be downloading a copy of the PDF file for this presentation, so you'll be able to get that. I'll download that in a few minutes so that you can actually follow along during the session, make notes if you would need to. So you probably won't have to take physical notes because you'll get this full presentation as is. So today's presentation, today's webinar is going to be presented by the Montreal Exchange. Now they've got a learning series, an options learning series, series 1 through to 5. Today we're going through series 1, and today we're doing part C of that, options trading mistakes to avoid. So if you've missed any of the other series, simply go to our Webinars on Demand on our YouTube site to get those, and if there's any that you cannot find and you would like to have it, let me know and I can get something out to you. One thing just to keep in mind, we have changed platforms recently, so I can only go back to February of this year, February 2017. But nevertheless, we will be going forward with all the other series for the remainder of this year and into next year. So today we have with us Patrick Seresna. Patrick is the founder and the chief derivative market strategist at Big Picture Trading Inc. He's a chartered market technician, a derivative market specialist, and a Canadian investment manager by designation. In addition to the Big Picture Trading, Patrick is an instructor on derivatives for the TMX Montreal Exchange. He educates investors and investment professionals across Canada about the many valuable uses of options in their investment portfolio. Patrick also co-hosts on the macrovoices.com, one of the most prominent financial podcasts in the market today. So I'm pleased to present to you today Patrick Sresta, who will facilitate us now for the next 40 or 45 minutes, and then I'll join back in to wrap up at the end. Patrick, over to you.
All right, thank you very much. One second here, we're just going to get my screen shared here, and we'll get today's session started. There we go. Fantastic. All right, how's everyone doing today? We're going to cover today a topic on options trading mistakes to avoid. It's the idea of asking the question, you know, someone who just starts into options trading and they go and start placing their first trades. What are some of the things that we can help you overcome some of the early mistakes that traders make and learn through the School of Hard Knocks? If we can accelerate you and get you getting a more positive experience with options, then you're more likely to continue to use them moving forward. So our goal here is to really try to help you overcome some of these initial obstacles. Of course, there's the disclaimer we always talk about, which is essentially us suggesting here that this is all purely for educational purposes in regards to what we're going to be covering. So the agenda today is using options as an all-purpose strategy. We're going to look at the idea of buying cheap options and what are the pluses and minuses of going for these lower cost options there. We're going to talk about the mistake of ignoring implied volatilities, and we want to talk about what implied volatility is and how a beginner can just make some very basic rules of thumb in terms of anticipating what is happening in the markets, and then we're going to obviously look at everything from earnings, dividend payments, and other things like that in regards to some of the considerations for options pricing. So let's get into the first topic of using an all-purpose strategy for trading options, and so this is a first obstacle, which is basically someone who just says, I just do this, and they don't customize their trades or look at the circumstances to see how implementation can be done more accurately. And so so we always say that options can be used for a variety of market conditions. I always teach about options being used as a tool, and as a tool we can use it for income, we can use it for protection, we can use it for strategic leverage, all sorts of amazing things you can do with options, and we can do it in all sorts of market conditions. What is important though is that for investors to have a clear understanding of what they want to accomplish. It's a strategic tool that has to actually strategically be used. In other words, I'm looking for a specific objective, and the option is a tool for achieving that specific objective. So when an investor understands the dynamics of the options market, they can construct a strategy to meet those unique objectives. And so you want to be able to stop and ask yourself, what is this option? How does it work? What do I want from this stock or this exchange traded fund, from whatever I'm trading the option on? And how do I select the right option to express the trade as to what I anticipate to actually happen? So each strategy has unique considerations, and some of those unique considerations are obviously driven by things like risk-reward. And risk-reward is very important. Ultimately, creating asymmetry in trades is one of the objectives almost every trader seeks. Like, how do I lose small, win big, right? How do I engage a trade, manage the risk effectively, and yet at the same time have the opportunity for extraordinary gains? It's about trying to discover that risk-reward proposition. At the same time, you have to, when using options to achieve this, like for instance, whether you buy a stock and you buy the insurance policy, the protective put on it, or whether you use a call option instead of owning the stock, what you're looking at is that risk reward. But the risk reward has to be traded off against the time depreciation. Unlike, when we did the options fundamentals session that was just several sessions ago, and we talked about what is a call, what is a put. One of the things that we talked about was the fact generally an option costs money. You have to pay a premium to buy a call or to buy a put, and that put option is a function of time. And so every day you hold that option, it costs a certain amount of money. It experiences a certain amount of time decay. And so what you want to do is not only look at the strategy you're trying to implement, but you also want to ask yourself an important question as to what time frame you're going to need to find out whether you're right or wrong about a trade. Right? And the next element there is the impact of implied volatility changes. And so in this scenario, you might have a scenario where the implied volatility is actually increasing or decreasing in throughout the period that you own it. What does it mean? How does it impact my overall decision making? As well, take into consideration things like commissions. Obviously, while options are this amazing strategic tool, you have to ask yourself that important question: does it make sense after all the transactions that I'm doing that this actually is a practical and reasonable thing for me to execute? There's nothing worse than selling a covered call on 100 shares of a stock that you own, and the commissions take more than half of your profits away. Well, then you have to really kind of ask that question. I mean, do you have the economies of scale to justify doing the transaction, versus someone who has 1,000 shares can absorb the commissions without even it impacting the P&L of the position at all. The last point I'd want to take into consideration on options is complexity. While a lot of options training programs really focus on this idea of, while these options programs talk about about building these advanced strategies, butterflies, and all these complex spread combinations and things like that. But often, the more complex something is, the harder it is to manage, and the more transaction costs you incur. And often, a lot of the benefit of all of this complexity often is traded off. And so you sort of want to look at, sometimes simplicity is the best. You want to see a straightforward thing that makes complete sense, that allows you to manage the trade effectively, right? So what are some of the realities? Each strategy will perform differently depending on market conditions. I'll give you an example. Covered call writing over the last 7-8 years has been a compellingly profitable strategy, because in the end we haven't really had a proper market correction in the last 7-8 years. Yeah, there was those little scares in 2015 and early 2016 where the market had those 10+% little downdrafts for a week, when almost immediately recovered. But in general, an investor that was committed to something like covered call writing has done incredibly well. But if the market conditions change, and we, let's say, have the economy falling into a recession and some kind of bearish price action in the markets was to ensue, covered call writing may not yield you the types of returns that was in the last 7 years, right? You have to kind of always look at market conditions matter. Not only that, with today we're in very low implied volatility periods. It's a period where the cost of insuring a position is relatively cheap at the moment. But at the same time, someone who's generating income with options is not getting very much income for selling premiums in today's market. So what are some of the musts that we always suggest to investors? Number one, assess market conditions to determine your objectives. You always want to kind of be able to look at what is the environment, and is this an environment that will make this a favorable trade for me, with all things being taken into consideration. The second thing is research available on option strategies, right? So you want to be able to assess the situation and ask, you know, what strategy should I implement and how should I do it? You want to create a plan to manage the position. So you want to kind of ask yourself, what is it that I have to do and how am I going to do it in regards to managing a particular trade? What's the execution? What's the plan once I'm in? Of course, then it comes in the execution. You actually have to have the ability to therefore take the plan that you've created, the strategy you have the intention of doing, and then act upon it by executing the trade. You want to be able to really take advantage of the opportunity and accordingly take advantage of it. So nonetheless, it's about managing expectations accordingly. It's a process of just knowing what you want and how you want to do it, and then managing those expectations along the way. So I want to move on and talk about buying bargain options. You know, we use the word bargain because we want to really express the idea. What the most common characteristic of a lot of investors is they'll turn around and they'll assume that just because an option is cheap, it's good, right? They look and say, oh, this option's 25 cents and this one's $1.25. I like the 25-cent one because it's cheap, right? And it's this idea that you know, if it costs me less, I can buy more, and if I can buy more, I can make more money. So let's explore that a little further. So in this scenario, I'd say many investors wish to leverage their capital by purchasing these bargain options. These cheap options are almost always, we use the term out of the money. So if you're not familiar with the term out of the money, not only do we reference it in our options fundamental session that we did earlier, but I'll just give you a quick run of the situation. If you let's say Suncor was trading at $40 a share, and you bought a call option giving you the right to buy the stock at $42. You're buying an option that is out of the money, because what you really need is Suncor to rally from 40 up to $42 just to justify coming to the price from where it might even be worth for you considering doing it. And so the option is cheap because it's out of the money. It needs the stock to rally in order for it to build any intrinsic value, right? So the next question here is, you know, options are priced based on probability of being in the money on expiration, and so. This is the most important thing I want all of you to reflect on. It seems like a lot of words, but I want you to just step back and recognize an options price is based on probability. So if you accept that to be true, what does a cheap option therefore imply? A cheap option implies a very low probability of being right, or at least of being in the money at the expiration. What is happening is that the option is cheap for a reason, right? The more expensive options have a higher probability of having intrinsic value or a value at its expiration. And so by you focusing on cheaper cost options, you're also inadvertently buying options that have a greater probability of expiring with no value. So what do you think, if you're always just focused on buying cheap options, I'm asking you a question, right? If you're always focused just on buying cheap options, invariably, what is the experience you're going to get? You're going to get a very large amount of positions that are going to likely expire with no value. And if that's what you got, then how do you think your first experience with options will be? It'll be disappointing. Every option I buy just expires worthless. So this options trading is not for me, right? Well, what you want to recognize is that you're choosing. It was the process of which you're choosing those options is a direct derivative of the probability that you're actually going to be making money. And so by you just inadvertently focusing on the cheapest options you can find, you're also picking the options that have the greatest chance of expiring with no value, right? And so you have to step back and really ask yourself, what is the right way of doing this? So I always say investors must learn to select the strike prices appropriate to their objectives. You want to ask yourself, what do I want, and what is the option that gives me the best chance of actually participating within that opportunity? And so, so in this situation, we have XYZ, which is trading at $53.66. So we have just a random stock. And at this stage, let's say the call options that expire 2 months from now, so we're talking about 60-day expiration. You can see here that we could buy a call option that gets at the $50 strike, 54 or 58. Now, so let's just review from the options fundamentals. Some of you may not have been in that option fundamental class, but what is the strike price? Is the price from which the call buyer, in theory, can exercise their right to buy the stock. Now, of course, many of you may choose to trade options by buying the call, later selling the call. You use the call option as a trading vehicle, and you never take ownership of the stock. There's nothing wrong with that. You can buy and sell options in the market, and you can use them as a trading vehicle. But I don't like to teach it that way. The reason why I don't like to teach it that way is because there's a reason an option has a certain value, is because you had the right to exercise it, and it builds intrinsic value, which gives it the option, it's the meat on the bone value that makes investors cash. And so what we have is a strike price of 50, which is, if we bought this contract, we would have the right to be able to exercise and buy the physical shares at 50, even though the stock's at 53.66, right? So where's the stock trading? 53.66. A $50 strike gives us the right to buy it at 50. Now, that makes the option more expensive, right? Because in the end, we're buying $3.66 cheaper than where the actual stock is trading on the open market. So you can notice that the premium for that option is $4.40. It's the reason it's $4.40 is we're literally buying an equity stake in the company. We're buying that $3.66 of equity between $50 and $53.66, and so only the remaining difference between $4.40 and the intrinsic value of $3.66 is the time value in the option. And because it has incredibly high probability of expiring with a value, that option is going to reflect that $4 cost. It's a more expensive option because the odds are you're going to be in a position of having some sort of value in the option at its expiration. Notice your break even on the $50 strike, right? It's $54.40, right? So you have a $54.40 break even. Now, one investor might turn around and say, well, you know what, $4.40, that's too much for me to pay for a call option. I want to buy the cheaper one. So the next investor chooses the $54 strike, right? And so in choosing the $54 strike, what they're securing is a contract that gives them the right to purchase the shares at 54. So the stock's at 53.66, and this investor has the right to exercise the stock at 54. So if you take $54 price of purchase and this option costing $1.65, the break even on the upside if held till expiration is $55.65. And so you can see the break even is higher with that call option. Now, everyone sees the column with delta. Now, we're still in the early stages of this beginning class on options through Scotia iTRADE. And so we haven't covered delta yet. But to give all of you a very simple explanation, the delta is the rate of which the option is behaving like the stock. So you want to think that the delta of the actual physical shares of XYZ is 1. And so when the first option has a delta of 80 cents, what you're basically saying is that this option right now is moving 80 cents on the dollar. So if that XYZ stock went from 53.66 to 54.66, that option would increase by about 80 cents in value. Now, notice with the $54 strike one, the one we were just talking about, its delta dropped to 45 cents. In other words, now this option is only changing 45 cents on the dollar for a $1 move in XYZ. By the way, the deltas are not constant. I don't want to confuse everyone. We have an entire advanced session where we go into greater detail about these option Greeks. Just all I want you to understand is a delta is the rate of change of the option for every $1 move higher or lower in the stock. And just note the delta doesn't stay the same. So delta might increase or decrease depending as the stock is moving. Now, notice though, the one that naturally attracts speculators is that $58 one. The $58 call, giving you the right to buy this $53.66 stock at $58, is only trading at 30 cents. And someone immediately is thinking, my goodness, I could literally buy 15 call options for the price I pay for one call option at the $50 strike. Right, and so immediately the dollar signs in the speculators' minds are immediately drawn to the fact that there is huge leverage of their money available by choosing the $58 strike. But recognize that come expiration, if that stock is anywhere below $58, that entire option expires worthless. And in order for you to break even at expiration, you would need that stock to be above $58.30. So its delta is a mere 13-cent change for a dollar move in the stock. On a percentage basis, that's almost a 50% move in the value of the option. But you want to recognize that that $58 call option is incredibly speculative, because in the end it has an incredibly high probability. In fact, I would tell you right now, based on this option pricing, just from me knowing how option prices work, that would be options market would be assigning an 85% probability that that $58 call will expire with no value at its expiration. So if you turned around and bought that $58 call, you are literally saying, I have a 15% chance of actually making a lot of money on this option, but I have an 85% chance it's going to expire with no value, and it's just going to be a loss. And so understand that if you turn around as an investor and you just focus on that $58 option, then you're immediately going to experience a lot of options that expire for a full loss. So how do you think your experience with options would be? It would be just experiencing a lot of losses, and you'd be like, oh, this is frustrating, I don't know how to figure this out. Well, you're buying options that are priced for a very low probability of success, right? And that's just a reality. So if I was to share with you a chart on the stock, you can see that your break-evens on the positions are considerably at different levels. And so you have to ask yourself, is it better to be conservative, or is it better to be more aggressive when it comes to this? So what are some of the other considerations? Out-of-the-money options are composed almost completely of time value. And these options, while you could have a much higher percentage of return, I mean, this is where out-of-the-money options have a very lottery ticket feel to them. It's kind of like your odds are you're going to lose, but if you win, it's going to be a big kahuna, right? And so it attracts a lot of the speculators who are seeking that kind of adrenaline rush of, I might lose $100, but if I nail this one, I'm going to make 1,000, right? And that appeal, it draws a certain type of personality to it. And I think it gives, to be honest, options a very bad rap, because you don't need to use options to do that. Yet it's very natural for investors to be drawn to it for those reasons, right? I always say that the probability of the option expiring worthless is very high, and therefore at the money or in the money options are more expensive, but offer investors often that intrinsic value and much lower break-evens, which actually give you a much greater chance of actually making money, even though it might not be that really sexy percentage return that a lot of people seek when trading options. So the next thing I want to talk about is short-term observations. Short-term options are less expensive relative to long-term option dates. So a lot of people say, oh, look, this 1 month option's 10 cents. Well, this is due to the fact that probability of an option being in the money at expiration, you have a lot more time to be right if you buy more time. And so time costs money. And that's just a very important thing to always never lose sight of, right? Sometimes better to pay a little bit more money and have lots of time to be right versus taking a very short result opportunity and trading accordingly. So the longer the time a stock has to move, the higher the probability it will happen. So you can see here, time decay is not linear. You can see that when you buy a certain amount of option premium, the longer term options decay at a much slower rate of change. And there's a linear aspect to this, or exponential aspect to it, where there's an acceleration of the rate of time decay. That if you buy, let's say, a 1 month option, you'll experience a very rapid decay of the value of the option sequentially. It's just going bam, 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 bam. It's going to just rapidly fire off and cause the option to lose value quickly. And so while those shorter term options are very attractive because they're so cheap, you'll also recognize is that they'll have a very all or nothing element to them. It's very hard to recover any of your option premium once on something once it if you're buying too short term. The moment it kind of goes against you on a very short term option, it almost immediately starts to suffer a bit. Nonetheless, the next thing I wanted to touch on is ignoring implied volatilities. And I just want to talk about just some considerations on volatility. Number one, historical volatility is a lot different than implieds. Historical volatility is rear view mirror. You can all look at the historical volatility very easily. You put up a chart and you ask the question, what did the stock do in the past? Right? It's really easy to see historical volatility. But the implied volatility is the market's anticipation of what volatility will be into the future over the life of the option that you own. And so what are some of those considerations? Those implied volatilities are pricing in all risk. Therefore, if, for instance, stock was not volatile for the last 3 weeks, but next week it reports its earnings, well, guess what? It's now got a price in earnings volatility. It doesn't matter that the stock didn't do anything for the last 3 weeks. It's about the fact that earnings is next week, right? It's forward-looking in its pricing. All pending announcements, mergers, all macro events, the volatility of the whole market, these are all considerations that go into your volatility. So, and the next, how about your price adjustment? Well, implied volatility is expansion and contraction will influence the option price. I'll explain this to you as an example here in just a moment. But it helps investors manage expectations to make better contract and strategy selection. You can also be right about the direction of a stock, but you can be wrong about the volatility, and the trade may not be profitable. So let me give you an example. There's a stock trading at, let's say this is right before its earnings, and right before its earnings the stock is trading at $62, and you buy one of these really cheap out-of-the-money call options for 30 days out. It's not that super cheap, but you buy a $70 strike call option. So remember, you have the right to buy at 70, and that option based on a 70% implied volatility is $2.05. Now, what you want to observe is that, let's say 3 days later it has an earnings announcement, and the stock actually is right. I mean, the stock jumps from 62 to 66. It's moving in the right direction. You believed it was going higher, and it did. But what happened to its implied volatility? Its implied volatility when we bought the option was 70%, and that implied volatility collapsed to 40%. So what you will see is the delta, or the benefit of the stock rising, contributed $1.21 to the value of the option, but you got hammered $1.80 of vega risk or volatility risk on the trade. And even though you were right about the direction of the stock, you were still losing money on the option on its expiration. So what this was a trader that knew what they wanted. They thought the stock was going to go higher, and they did, but they didn't realize volatility considerations. They didn't recognize the volatility has to be taken into account. And what I can assure you is that if you're trading an option before a major event, whether it's an earnings or some Fed announcement or some other scary thing that the market may interpret as such, like a Brexit or something like this, you will always be paying a higher volatility premium, which will then later on be extracted from the option, which means that if you're buying events, you're always paying a premium on your options. You should always take that into account. You have to be careful. That's where learning more advanced strategies like debit spreads allows you to hedge that out. So next thing I want to talk about, disregarding earnings and dividend payments. Earnings, option premiums typically increase when earnings are about to be announced due to the increase of its implied volatility. In fact, a lot of covered call writers love to sell their covered calls right before an earnings because they're getting an income premium kicker in selling the option into its earnings. So we always say this is the premium reflecting the increased risk of a surprise earnings announcement. So what you want to think is that there's a counterparty to every options trade. Why is a counterparty not going to increase the risk premium that they expect to be paid right before an event? Why would they just give it to you and take all the risk on themselves and not have you have to share that by paying it into the options price premium? So when you are a trader that loves to trade earnings announcements, things like that, you have to be very careful about how much of a premium you're paying on this. And so the expectation is that the stock is likely to be volatile, but it is uncertain as to which direction it is likely to go. So what are some of the other typical mistakes that investors make? Investors often can believe that a stock is going to make a significant move higher or lower on its earnings, but wish to buy a put option, let's say, to participate, but they don't recognize that the implied volatility has been expanding, making that put option expensive relative to its historical levels. So here's a chart that we can reference, and I want you to observe on this options chain that you can see that this has a 30-day historical volatility of 15%, right? But notice that when we look at the call options here and the put options, notice that the implied volatilities are up in the 20 to 25% ranges. In other words, you're seeing literally almost a 5 to sometimes as much as a 10% implied vol pickup on the option premium, let's say right before its earnings. So in other words, you're paying a juicy earnings premium from what the stock's historical volatility has been, and that's a very, very important consideration that you have to take into account when trying to play earnings. Now, most of you might be technical analysts. You can turn around and say, I see a breakout and I'm going to buy a call option because I believe the stock's going to go higher off of this level. Well, if you're going to use a breakout or something like technical, well, I mean, now you don't have as big of a worry, because if you're trying to play the earnings story, you're going right into the eye of the hurricane when a lot of the implied volatilities have to spike. But at random moments in the stock's history, its implied volatilities might be very normal and even below its historical amounts, and therefore buying the option at that time would be actually very cheap and very strategically smart to do so. What is the message I'm trying to deliver to you here? Just take a look. Understand that if you are paying an excessive premium over its historical implieds or historical volatility, then you want to recognize is that you have an increased risk that if volatility has a reversion back to its average, that it's going to hurt the value of your option and make it harder for you to be more profitable. Obviously, if you're dead right and the stock skyrockets in that direction, you could still make piles of money even if volatility isn't there. But this volatility consideration is going to be a drag on your performance, right? It's going to be a headwind that you're fighting if you pay too much of an implied and it's moving against you during that time. So what are some of the risks? Implied volatility contracts, the option premium will drop in its value, and therefore this means that the stock could move in the investor's favor, but not significantly enough to compensate the drop in the implied. So that was that example I gave you earlier, showing that the return on the one was not enough to compensate for the other, and that's just a very important thing to always take into consideration. This means that the stock, so what I would say here, investor could be correct in their forecast, but incur a loss because the option strike price selection as well as the volatility considerations weren't in your favor. I don't mean to discourage people. There's all sorts of amazing ways to do this. I just want to emphasize the rookie mistake. The rookie mistake is someone says, I'll just buy a call. It's the day before earnings. I think it's going to go higher. I'll just buy this out of the money call because it looks cheap. And they turn around and that option expires with no value, and they're shocked that it didn't work out. And really, in the end, what it is was just a whole pile of rookie mistakes that you were incurring. And if you just learn how to overcome those, you immediately give yourself a higher probability of success. Nonetheless, just a couple highlights about uncertainty. Earnings also represent a significant uncertainty in the pricing of the stock, and so that means that if the stock could move in the investor's favor, but not sorry. That's a slide we already covered. Sorry, I just went the wrong way here. Sorry. And so if all known information is priced in ahead of earnings, there is the potential for a surprise on new information, right? So this could result in a significant move that may be different than anticipated. So it's just about knowing the nature of option pricing. It's just about how options work and what do I have to take into consider in doing so. So just a few other highlights I want to talk about is dividends. Now dividends, share values are adjusted lower by, option values are adjusted lower by the amount of the dividend by the ex-dividend date. Actually, the share value does too. So like when a stock goes ex-dividend, and let's say Scotia Bank is paying a 50-cent dividend, I'm just making something up here, then you'll see that the day after it pays its dividend that the stock price drops by 50 cents. It's a very natural drop. So this may impact the value of an option contract, but what I wanted to just highlight is that one has to recognize that dividends are priced into the option's price. And so you actually, if you own a call option before a dividend, what you want to think is you actually got the option at a discount because the dividend is discounting the price of the call. Alternatively, if you buy a put option, then it actually is a higher cost to the put because it's also discounting the dividend right before its dividend payment. And so what you'll see is that the reason this is done is to remove arbitrage. What you want to think is that if this pricing was not done, then what would every investor do right before the ex-dividend date? They would turn around, buy the shares, sell a covered call, use the covered call to pay for the put, remove all risk of loss, turn around and collect a free dividend. And the one thing I can tell you is while options are an amazing tool, the market is not in the business of cutting free checks to investors. In the end, what the market does is it has to accurately price the option for all of these different risks. So investors trading options must be aware that when dividends are to be issued, because you have to know what are the considerations for that. So next thing, for an option writer, there is the possibility of an early exercise before its ex-dividend date, and so this is a very important consideration. So the chances of an early exercise are greater if the option's time value component of the premium is less than its dividend. So what do I mean by that? Well, if you turned around and you bought the shares and you sold a covered call, and there's only 10 or 20 cents of time value left on the option, and the rest is intrinsic value, and the stock's about to pay a 40-cent dividend, there is a very good probability that you will be forced to exercise, and so the counterparty will exercise their right to buy the shares from you, and do it right before the ex-dividend date. So you always want to recognize what are the conditions from which that risk can exist. The simple way to calculate that is just look at the time value in the option and compare it to the size of the dividend. And if the dividend is larger than its time value, then you have an increased probability of being exercised early. So the call buyer may feel the benefit of receiving the dividend outweighs the benefit of continuing to hold the call, which may often lead to you choosing to let's say close out the call option and continue to, let's say, own the shares or something like that. It's just a consideration that you always have to make. So what do we want to say as a conclusion? Well, you have to look at the plan. So I would say plan your actions. Build a plan. Generally, building a plan generally results in an investor who will choose the appropriate contract and strategies, make less emotional decisions, feel in control of their trading, manage their risk, and lock in profits. And so those are very important considerations. I wanted to bring to your attention, in addition to Scotia iTRADE providing amazing webinars and amazing content to their clients for all of these different resources that they offer, at the Montreal Exchange, we're committed to your education as well, and this is why partnering with between Scotia and the TMX Exchange is such a powerful combination. Between the two, we provide so many resources for investors. There's a phenomenal blog which I regularly write on optionmatters.ca. There's all sorts of newsletters, videos, and webinars, strategy guides. There's a lot of people will type in the question, ask me, well, what book do you recommend for options trading? Well, guess what? There's a 150-page options strategy guide on the website that is completely free as a PDF for you to get your options investing education. It's on there. All sorts of strategy pieces on there. There's options calculators, a covered call calculator. There's a paper trading account. Some of you are like, well, I want to practice using options. Perfect. There's you can go right there. You can open a trading simulator, literally fund an account with some paper money. Let's say you put 100,000 in there, and you could practice placing the trades on the Canadian Options Exchange and see how you do. I always challenge all of you to go in there and buy almost all the same stocks that you currently own and overlay options on them and see whether your simulated account does better than your live account. It's always an interesting exercise of seeing whether or not you are adding value to your trading portfolio by doing that. In addition to that, there's the new options play feature, and the options play feature, if you go and wanted to go directly to options play, you're paying $50–60 a month. For Canadian stocks, options play is free for Canadian stocks and options. Phenomenal resource, also available on our website for free. So make sure you take advantage of all these amazing resources as we move forward. Anyway, I'm going to invite Colin back online to drive the Q&A. Please, if anyone has questions, please ask them. I'll stick around here for a few minutes and make sure I answer anything that you have in regards to trading. So let's bring Colin back on here.
Great, thank you so much, Patrick. Really appreciate that. That was a lot of information, and I hope you've got the handout, so you'll be able to refer back to that again. And also, if you've got questions that you didn't have answered, you can always send that email over to me, education@scotiaitrade.com, and I can communicate with Patrick and the Montreal Exchange and get some information to you. But right now, if you've got some questions from this webinar, you can just type them in, and I'll get them over to Patrick as well for response. In the interim, what I will do is I will just oh, here we go. We have a question here. Okay, so Claude is asking, would the price of options go up as the stock price goes up?
That's a very good question. Yes, is the simple answer. That's what the delta is, right? And so what happens is, and that's specifically call options. Put options are the reciprocal. They go down when a stock goes, so they go up only when a stock goes down. But call options are meant to be often stock replacement tools. So rather than buying shares of a company, you buy the call options to have the right to buy them in the future rather than buying them right now. And if you're right about the direction of a stock, they will increase in their price as a stock is appreciating. That was when you heard earlier we talking about delta. Delta is the rate of change, which is the rate of which a call option will increase for a $1 rise in the stock, and so it's giving you the rate of participation there. Hope that answers your question.
Great. Thank you so much, Patrick. Claude, I hope that answers your question there. Oleg has a question. How does the balance of the put or call open interest influence the selection of the strike price?
All right, that's a great question. What I always say is that there's two types of traders. One is a short-term trader. If your intention is to trade an option, which is, let's say you're a swing trader, you buying it today, and you maybe even later today or tomorrow or the day after, you're planning on clipping it for a quick move over 2-3 days, and you want to sell the option for a quick profit, and you're using it as a trading tool. Suddenly, open interest and liquidity and spreads become far more important because they're going to directly impact your short-term profitability. Now, alternatively, there's a second way to use options, and that's what we call as an options overlay. And we're going to be talking about in the upcoming webinars that we're doing together, everything from covered call writing, buying an option as a protection or protective put on a stock that we already own, all sorts of really neat things like this. When you are buying an option like that, then the liquidity and open interest is not remotely as important because you owning the stock is the core trade. The option is an overlay to remove risk or generate income, and you're not buying and selling the option as a short-term trader. You're using the option to somehow combine with the stock ownership. And so in a trade like that, open interest and liquidity are not important as much as doing it at the right strike prices and for the right reasons. And so it's not a right or wrong answer, but the way I would say is this: the shorter term you are in trading and the more you intend to buy it low and sell it high for a quick profit, the more open interest and tighter spreads and things like that become a consideration. In Canada, we have about 20 Canadian companies that have very liquid options, and they're easy to detect. They're just the largest mega cap stocks in Canada. Obviously, all the major banks, all the major energy companies, all the major gold miners, they all have very liquid chains, and they usually have good open interest. So the way I would say it is that if you are an active trader in Canada and you want to use options, you got to focus on staying with those 20 really liquid names for active trading. But once you get in the world of income, of covered call writing, or buying a stock protective put on a stock position, you really can go anywhere with that. I mean, at that moment, the spread and things like that are not as big considerations.
Beautiful. Thank you, Patrick. Oleg, I hope that answers your question there. We've got a question here from Matthew. How are American versus European options sold on the TMX?
Well, that's a good question. American-style options encompass the vast majority of options. That's the same in the United States as well. The European settlement are exclusively reserved for index options. So if you're going to the SXO, which is the Canadian TSX 60 index option, or you're, let's say, trading the USX, which is the US dollar options on the currency itself, those are European-style settlement in Canada, and those are settled in cash, right? But the vast majority of individual company or stock options, as well as the ones on the exchange traded funds, are almost all American-style in their settlement. So it really is about whether you're doing one of the Canadian indices or whether you're trading a stock or something like that.
Great. Thank you, Patrick. There are a few more questions here. I'll see if we can get through them. So Patrice is asking, why are commissions higher for options than on stocks?
Well, I mean, you could probably answer that question more than me because you're working at the brokerage. But it really, in the end, what it comes down to is that options have an exchange fee, and that exchange fee is transferred over to per contract to individuals. So there's a base commission, and then you're paying an individual exchange fee within their per contract for trading options, which increases the commission on it.
Okay, beautiful. Thank you so much. And Patrice, I hope that gets the heart of your question. Catherine is asking, what's the time range for short-term and long-term options?
Well, you could buy weeklies. Right now, the Montreal Exchange, the TMX, issues Canadian options on weeklies. So you can literally go, you have a 1 week, 2 week, 3 week, 4 week, and 5 week option available on most of the big name mega caps here in Canada. I mean, mega cap is smaller than the U.S. mega caps, but like the Royal Banks and the Scotia Bank and all these other ones have these weekly options on them, and there are options going out to 2020. So you have these long-term options available as well, and so there's no shortage of selection of different time frames to express your ideas.
Okay, great. Thank you so much. Now here is a question from Cloud, another question from Cloud. It's a bit of a tricky question, and we may not be able to answer it, but Cloud is saying, could you give an example of how much a $100 investment could return on an options the investor predicted correctly?
Oh, that's not an answer that you could give, because that's all relative to the option. The risk-reward payoff, like if you go back to that example where we were choosing between the $54 and $58 call strike prices when we were talking about buying these cheap bargain options, understand that each one of those options is going to make a different percentage return on capital than the other. Each has a different delta, each one has a different thing. What I would encourage you to do is visit the TMX Montreal Exchange website and use the options calculators. What happens is that you can plug in your scenario into the simulator, and you can actually simulate, well, what if the stock rose $3? What would this option have made? Because it really is an option by option style return. That's why the selection of options is so important. You know, I train people all the time, you know, on how to trade options. That's what I do for a living, you know, and it's not a simple question to answer on a session like this.
Right. Now it's 1:56, 4 minutes, and I do have to do some closing comments. There are 3 other questions that, let's see if we can grab these real quick, and then we'll
okay, we'll rapid fire answers. Let's do it.
Okay, beautiful. Thank you so much. Pascal has 2 questions. Is buying, selling options with wide bid-ask spread another pitfall in options trading? His first question.
I don't consider that a pitfall unless you're doing short-term trading, right? Like I said, spreads only really matter if let's say I was buying an option with a 30-cent spread and it's bidding 60 cents, 90 cents, and I buy the option for 90 cents looking for a quick pop. The stock pops $1, and now that option is bidding $1, $1.30. And well, now if I sell to the bid for $1, I made 10 cents. Basically, the spreads ate all chance of me making money. That's because I was very short term. So back to the question I tried to answer earlier, the spreads matter most if you're short term in trade in nature. The longer term you're in nature, and the more you're using the option as a strategic overlay on a stock you own or something like that, the less important the spread is. The more you're using the option as your trading vehicle and more you're looking for a short term move, the more it is detrimental to your profitability to deal with those illiquid options. And so it's about the nature of your trading. That was longer than you probably wanted. Okay, let's go to the next one.
Okay, and so Pascal's second question here is, commissions in Canada are way more expensive than the U.S. Why would that be?
Well, that's broker specific. The exchanges are the exchanges. They do that. So I have no comment. In the end, Canadian brokerages have their policies, what options are, and or the commissions are, and that's and anyway, I'm going to leave it at that. I don't want to take my hole here.
No worries. We've got 2 minutes to go. So what we're going to do then for the remaining questions, I'm going to just take those down and I'm going to send them over to Patrick and then email the answers out to you so that we can ensure we can close off for the group. So Patrick, I really want to thank you here. Let me just do a quick few closing comments and then we'll end this one down. I'm going to switch the presentation back over to me here and I will close it down. Okay, great. I should be on my presentation screen. Here we go. Okay, so what is next? As you exit the webinar, a short survey is going to pop up on your screen. We ask that you just spend a few minutes and just let us know how we did today and how the information and the presenters were. And if you have any other suggestions for what we could be offering to you, please let us know this as well too. Also, as I mentioned to you before, you can access webinars on our YouTube channel, or you can email us at education@scotiaitrade.com to request a copy of recording links if you don't find the webinars there. Now, a couple of webinars coming forward. One is coming to us on October the 10th, Tuesday, October the 10th, cash management using EFTs, and that's going to be provided to us by Horizons ETFs. And the second one by the market guys on Thursday, October 12th, bullish and bearish engulfing patterns. These are technical analysis. So 2 webinars that you might want to look to. Simply go to our education tab under the scotiaitrade.com website, click on events calendar, and there you can register for one of these webinars or any of the other webinars coming forward. As I'd mentioned to you, the Montreal Exchange does provide some great, interesting webinars, and that's done in a nice, good sequential curriculum format. So please go ahead and see if there are any webinars that you're interested there. So then, based on that, on behalf of Scotia iTRADE and the client education team here, I'd like to thank Patrick for an amazing presentation, great information, and I'd like to thank all of our attendees today for your time with us. We hope the information was amazing and will help you in your investment journey. So based on that, I will then wish you a very good afternoon, and we will see you in the upcoming webinars. Thank you so much, Patrick. Have a great day, everyone.
Thank you.